Hey guys, Mike here. So today we're going to talk about what's going on in the market, the emotions and everything, as I put on the thumbnail there for you, what we're going through. I'm going to show you exactly where the money's actually going with the charts, the numbers back it up, and shockingly where some of the money is being rotated into, which might surprise you, but it makes total sense and you'll be able to see it on the chart. Also here a couple of interviews, one from a professor at Wharton Business School. When he speaks, I tend to listen because he's been around a long time and he is a very smart man. Doesn't mean he's 100% right all the time, but he does at least tell it like it is, and he's been right quite a few times when I've heard him. So I want to let you hear that as well. And then what, we got to look forward to what the Fed is really worried about and what they're trying to avoid at all costs, okay? So if you're getting out of it, hit the like, subscribe button for me, guys, and let's get into this. And so I saw this morning on Twitter, guys, and I just wanted to share it with you. And you can see right here, this is the cycle of market emotions, right? We've all felt this before. Start off with optimism when you buy the stock and get the excitement, the thrills to watch it goes up, and everybody gets euphoric and starts piling in. That's usually when, of course, it starts heading south and you get corrections and stuff, and then you start feeling anxious, like, should I sell? The denial says, no, it's going to go back up. Don't worry about it. Then there's the fear and desperation, and then the panic sets in, which is when everybody starts panic selling, and that's when you know you're really close to the bottom, right? And then you get down to despondency, you're not even responding, you're like, oh my God. Then there's depression. And then here we go. It starts to move back up. So we get to a point of maximum financial opportunity is when you make your real money, or hope, or relief. And then we're back to optimism to start the cycle all over. And now here's that short interview with the Wharton professor I was telling you about. And pay close attention because I keep talking about 2018 and showing the charts. And it's good to hear somebody of his caliber talking about it as well.
Saying, we can't repeat 2018, but we're in a very different situation. We have $4 trillion more of reserves in the bank than we did back then. So when they began to run it off, it was beginning to tighten on the bank. We got $4 trillion. And we also have an inflation problem. Back then we had zero inflation, inflation below the Fed target. So I remember we are virtually at full employment, in some measures over full employment. And the second important goal of the Fed, and some say the most important goal of the Fed, is controlling prices. So yeah, there may be a market reaction. I actually think it's a rotation. That's what you're seeing. I still think we could have a good market this year, but certainly those with good cash flows are going to benefit, and those that have the discount rates go way out in the future when the Fed is being aggressive. So I don't think it's going to be a bad market. I think it's going to be a rotated market, and I see that's what you've been seeing in the last two or 3 days.
That's not going into where the money's, leaving from. And of course, it's leaving tech. You can see right here down 5% in 2 days right here. And then it's leaving healthcare. That's down almost 5% in, around 5 days as well. And where else is it leaving from? You got discretionary down around 4% in the last 2 days. And then, of course, real estate, which actually does well in high inflation times, but not high interest rate times, down 4%. And where's it flowing into? Energy, boom, up almost 9% in 3 days. Then you go over to the financials, and then you end up, all the banks are going up. So the financial sector has moved up around 4% in the last 5 days. And of course, where's the money coming from? This is pretty simple. They're selling FANG stocks, these high-tech stocks that have just hit high after high after high. Tesla's down 10%, Netflix down 7%, Microsoft 5%, Google 5%, Apple 5%, Amazon 4%, Facebook's down slightly. It's been kind of making a nice comeback. But the funny thing is, and this is where I was surprised at, I read an article on this, and look at what is actually going up. BABA up 5%. At the same time, our big tech stocks are down. Add in JD. It was going down, JD.com that is. And all of a sudden, look at the move up today. Big move up today for JD. And then if we add in Baidu, you can pretty much see is the trifecta here. It's up at the same time almost 3%. And so why is this? And it's pretty simple why you're seeing this. And this is what this article I was reading about. It said that, these tech stocks have been hitting all-time highs multiple times. Apple just became the first $3 trillion company. While at the same time, look at JD, Baba, and Baidu. Down between 30 and 55% since March of last year. And if you don't believe it's institutions, all you got to do is look at the volume, guys. This is right here. Look at that massive volume pushing this stock up. And compare it to the left over here, what's been going on before. Hardly any volume, right, compared to that. And then if you pull up Baidu, look at that. massive, massive volume pushing it up. You look to the left, whole lot less volume, right? And so that lets you know this is institutions. This is not retail. And it makes sense, right? I mean, you know, where is your bigger gains going to come from? Stocks that are at all-time highs, multiple all-time highs, you know, over and over and over, or a tech stock in a different country that isn't really going to be affected by what's going on here as much because most of their business is done over in China, right? And so that are down, you know, Bob was over 50%, Baidu's over 50%, you know, JD is down 30%. You're going to have a much better, you know, easier time getting gains out of those stocks versus what we're about to go through in this country with stocks that are already at all-time highs, right? And so that, it makes sense seeing it. Hopefully you saw in the volume there. And then, of course, you know, I've been talking about what happens with interest rates, showing on the charts. So, you know, here's somebody who actually is in the business, can tell you exactly what historically happens when you do interest rate hikes over the last decade.
Historically, the market would suggest ahead of Fed rates, the Fed interest rate increases, there's still an additional 5 to 10% downside to the NASDAQ. And so I just kind of anchor this, think about the near term and think about this anxiety. And I don't think we're done. Maybe the market's up a little bit in the next few days. Maybe it's down. But until investors feel the Fed has a strong handle on this, I think we're going to continue to move lower. I also want to be clear that I think that we will see a rebound. I think once the Fed takes strong control of this, or at least investors have comfort for that, I think you will start to see a rally in some of these tech names kind of in the final 3 quarters of the year.
And if you just look at this right here, I mean, this is the number of all-time highs from 1920 to 2021. Look at this run right here we have in 2013 and 2021, and that's actually 70 all-time highs. Only this 1 year beat us, and that was 1995. But look what happened after 1995. You went down to 39, 45, 47, 35, 4, and into 0 for quite a few years. And so, you know, you've had this just great run. And so, you know, who knows what 22 is going to bring. But I think we kind of all know it ain't going to be 70 all-time highs. So that's for sure on the S&P. And of course, what's really saving us on the interest rates, why they can't go as high as they want to go, because we just hit, we hit 29 trillion in 2021 of debt. And look how fast we are gaining here. We went from 21 to 29 trillion. Every single trillion was achieved in less than a year, some in less than a month. And of course, here's the debt clock, which I love. And here's what makes the most dangerous thing is the far right down there. 127% of GDP is what our debt is. I mean, look at that. That is double what it was 20 years ago. And so, you know, to recap, guys, one, you know, refer back to that emotional chart, right, about the market, because where you're at, that's where most people are going to be at. And you kind of look and see where you're at. And that's probably where the market's going to be at, right? So keep that in mind. You know, is it going to be a volatile year? Most likely, absolutely, yes. Can we have a good second half of the year? We could, you know, depending on what goes on with inflation, depending on if the Fed actually does start not only tapering, but lowering their balance sheet, dumping bonds in the market, right? And so, you know, what is the stock market not like? Surprises. Yesterday was a surprise, and so now they kind of got all their cards on the table. But we got the next Fed meeting coming up at the end of the month, and so that's something to keep in mind as well, or the Fed meeting minute, excuse me. And so that's something to keep, you know, in mind. And, you know, things still look right now short-term bearish. We'll have to see. I'm expecting a very volatile year, but it's good to know where the money's going. You can tell by those charts and stuff where you see big money flowing into, because remember, they don't have to make 20, 30, 40% to get paid. They're going to get paid regardless. They're going to make a lot of money on their bonuses and everything else, right? As long as we don't take our money out of, you know, all their funds and stuff. So keep that in mind. They're just aiming for that 8 to 10% beat the S&P type deal, and that might not be hard this year. So, you know, just remember that. And also remember when you tell yourself, well, the stocks can't go any lower, I would say this, keep this in mind. I said this to somebody in the Discord. You know, Ark K is down massive in 2021, and the NASDAQ set multiple all-time highs, okay? What happens when the NASDAQ goes into a major correction or multiple corrections throughout the year? What happens to Ark K stocks? You know, that's what you got to keep in mind, okay? And so I'm just putting that out there. I'm not saying that's what's going to happen. Just saying, you know, think about that. Because, I mean, how many times last year did you find yourself saying, this stock can't possibly go any lower, it's down 50%, and now some are down 90%, 5%. And so, yeah, so the institutions want to keep shorting them, they can drive them down into the ground, as we saw last year. So just keep that in mind, because they're going to make their money going up and down both ways. Okay, guys? So anyway, if you got something out of this, hit the like, subscribe button if you did. I really appreciate that. And I'll see you guys later.